Welcome back, everybody, to video number 3 on Chapter 7. And just to sum up the effective cost of debt here, if the coupon rate here is greater than the market rate, then the bond's going to sell at a premium. We're trying to sell a coupon, which is what's the rate on the bond that we're legally obligated to pay. If it's bigger than the market rate, we're going to pay a premium for that. If it's equal to the market rate, it's going to sell at face value, and if the coupon rate is less than the market rate, then it's going to sell at a discount. Okay. All right, the effective cost of the debt then is used to determine the interest rate. And the bond discounted premium interest expense is usually different from the cash the interest is paid. That long Excel spreadsheet at the very end, I did this one just to show you that even this convoluted example from Verizon works with that, what I lovingly call Steve's way, in calculating the value of a bond. There's other ways to use Excel to calculate the effective cost of debt. You're welcome to do it this way if you like. I just think my way is easier. All right, balance sheet reporting. We're going to report debt net of discounts, or including the premium. The details are reported in a debt footnote, just like is shown here for Verizon. Okay, you can see their long-term debt, their maturities, and other information. I'll let you read that on your own. These footnotes provide a schedule of the maturities of the long-term debt. You can see that here with Verizon's footnote as well. So, income statement reporting then is going to have the effective cost of debt. The cash interest paid, that's the coupon rate, plus a portion of the additional borrowing costs associated with the discount or the premium. And we will write off, or I should say write down or write up, that discount or premium over the life of the bond. It's called amortization. I won't get too excited about that in this video. We'd be here all day. In any event, the financial statement effects of a bond repurchase, though, if we repurchase the bond sometime before its maturity, then you might have a loss or a gain. And we will look to see what the net cash used in financing those consolidated statements of cash flow are. If the net bonds payable, if we subtract out what we repurchase, that's how you're going to determine whether there's a gain or a loss. And when a bond repurchasing does occur, that gain or loss usually results, and it's computed by taking what's left on the payable less what we repurchased it for. And that book value, that net bonds payable, I refer to as book value or carrying value, as does this text. So it's the net amount reported on the balance sheet. And if the issuer pays more than that to retire the bond, then the amount is carried on its balance sheet. It reports a loss on its income statement. If the issuer reports a gain on the bond retirement, if the purchase price is less than the net bonds payable, but less than the carrying value. Okay, fair value disclosures. GAAP requires the company report current fair values of their debt in footnotes, but not on the balance sheet. So the changes in fair values are not included in net income because gains and losses reverse with subsequent fluctuations in interest rates, and the bonds are repaid at maturity normally. So you can see that in these Verizon disclosures. You can read that on your own. So how do we explain the quality of debt? Okay, credit analysis. This is a fairly interesting and useful section of this PowerPoint because equity investors are focused on the upside potentials, whereas our lenders, they're more concerned with credit risk. And that's normally what we're concerned with in the company as well. So the risk that they will not recoup the amount they loaned or the interest is very important to the lender. So borrowers with higher credit risk are going to have a lower quality of debt and consequently are going to pay a higher interest rate. But the lenders focus on the company's ability to repay those borrowed amounts. And they are determined largely by two things. One, the level of indebtedness. The amount of principal and interest that must be repaid. Just like with we as individuals, the banks are going to be looking at that before they're going to give you any more debt. And then excessive cash. I shouldn't say excess cash. Cash is never excessive. That the company is able to generate. This provides the cash needed to repay the debt. And so the term excess cash means the cash the company is able to generate over and above what is needed for their ongoing operating and investing activities. We always like excess cash. Okay, so the market rate of interest. The lenders are going to require a higher interest rate as the borrower's credit risk increases and the quality of its debt declines. You can understand that, I think, very, very easily. So the market rate of interest, the yield, that's the market rate, is defined as the risk-free rate plus the risk premium. Now, we normally are going to define the risk-free rate as the yield on U.S. government treasury bills, notes and bonds, but generally treasury bills. There's nothing, of course, that's truly risk-free, but this is our lowest risk investment, treasury bills. And the risk premium is going to depend on the level of credit risk associated with the borrower. So, here are some terms that you may have seen before but maybe didn't fully understand. And I think this is a great presentation of this particular subject. Here we have the risk-free rate, and you can see that here in red. It, of course, is the lowest pay, too, as far as lowest paid interest. But here is our AAA rated companies, and you can see that it pays better than the risk-free treasury bonds. But then our riskier BAA corporate bonds have to pay a higher rate to entice the investors to take that higher level of risk. Okay, so what are these credit ratings? Companies that want to issue public debt normally seek a credit rating on their debt issue. And the big agencies that do that are S&P, we've talked about them a little bit, Moody's, and Fitch. But mostly Moody's is the one that I've used, but S&P as well. And they're all look pretty much the same as to how they grade. And you've got the AAAs up here at the top, here, and then as you go down, you get down here to the default area, and these are extremely speculative when you get down in these C ranges. Probably not investment worthy when you get down that far. In fact, you can see this little green line here. That really, anything below that green line is not an investment grade and considered speculative. So I think that's very easy to understand, better understand how these major credit rating agencies grade risk. And so they want that credit risk more accurately conveyed to and priced by the market that way. Each credit agency has its own rating system, as you can see, but they do have have things in common. So the two-step approach, this gets very complex in evaluating the riskiness of the company. They're going to assess the likelihood of a default. And how do they do that? They look at analyzing historical and forecasted levels of debt and the excess cash flow available to repay that debt. Pretty easy in theory, but the second step is to assess the potential loss that the lender would suffer in the event of a default. Potential loss given a default is generally a function of the way we structure the debt, and then to quantify the loss given default, the rating agencies consider collateral, loan terms, and bank covenants. These bank covenants, if you had a loan, they might say, hey, you've got to keep your current ratio within certain ranges. You've got to keep your other ratios within certain ranges of acceptability. And if you don't, the bank can come in and manage your company, sell off your receivables to pay itself off. You don't want to violate these bank covenants, and fortunately for me, I never have. Came close a couple of times, though. So, what determines credit ratings? Each rating agency has its own, and here is a very elaborate schedule. I won't go through this in too much depth. The country risk, the industry risk, and here we have our competitive position. That's our business risk. Cash flow and leverage is probably the more important of the two, although they're both important. That's the financial risk. So that's the anchor. And then we modify that based on how diversified they are, the capital structure, etc. And so that standalone credit profile then is grouped into the issuer's credit rating. All right, so here we go. Verizon rating score. You can see it has a BB+, positive A-2. Its business risk is strong. Its country risk very low, but its industry risk is intermediate. Its competitive position is strong. Their financial, intermediate, etc. I won't go through that. You can read that on your own. But I think that kind of gives you an idea of how S&P would assess Verizon when it comes to business risk, financial risk, anchor modifiers, management and governance is perceived as strong, but a comparable rating analysis results in a negative modifier. So the S&P assigned them a standalone credit rating of BBB+. Here, S&P concludes, I guess that's where we'll have to stop for this video.